If you're seeking a steady, reliable path to grow your wealth over the long term, then index funds might be the perfect investment vehicle. Index funds, known for their diversification and low fees, offer a powerful way to harness the stock market's growth over time. In this video, we will explore some of the top index funds you can buy and hold for the long haul, aiming to ride out market swings and benefit from the overall growth of the market. We'll break down what makes these funds so attractive and how they can form the foundation of a solid investment portfolio. With that being said, let's dive right in. Number 1. Schwab S&P 500 Index Fund. The Schwab S&P 500 Index Fund stand out as an excellent choice for investors looking to build a long-term portfolio with minimal costs and maximum diversification. Known for its affordability, this index fund boasts an exceptionally low expense ratio of 0.02%. This means that for every $1,000 you invest, you would only pay 20 US cents annually in fees. Such a low expense ratio is one of the key advantages of index funds, as it allows investors to closely match the returns of the S&P 500 index itself. Investing in the Schwab S&P 500 Index Fund essentially means you're investing in the 500 largest publicly traded companies in the United States. These companies represent a broad cross-section of the economy, spanning various sectors such as technology, healthcare, finance, and consumer goods. By holding a stake in these companies, investors benefit from the overall growth and performance of the US stock market. One of the appealing features of the Schwab S&P 500 Index Fund is its accessibility. There's no minimum investment amount required, meaning you can start investing with as little as $1. This low barrier to entry makes it feasible for investors of all levels, from beginners to seasoned professionals, to participate in the market with ease. In terms of performance, the fund closely tracks the movements of the S&P 500 index. For instance, in 2022, the fund experienced a decline of more than 18%, mirroring the losses seen in the broader market during that period. Similarly, during the first 4.5 months of 2024, the fund reported gains of approximately 12%, aligning closely with the performance of the S&P 500 index over the same period. The ability of the Schwab S&P 500 Index Fund to replicate the performance of its benchmark index makes it a top choice. Number 2. Fidelity Zero Large Cap Index Fund. The Fidelity Zero Large Cap Index Fund is designed to track an index comprising more than 500 US large cap stocks, closely resembling the performance of the S&P 500 Index Fund. However, what sets this fund apart is that it avoids paying costly licensing fees to S&P Global, the parent company of the S&P 500 Index. Instead of directly tracking the S&P 500, the Fidelity Zero Large Cap Index Fund follows the Fidelity US Large Cap Index as its benchmark. This strategy allows the fund to replicate the overall performance of the broader US large cap market without incurring the expenses associated with using the official S&P 500 index. One of the standout features of the Fidelity Zero Large Cap Index Fund is its expense ratio of 0%. This means that investors do not pay any fees directly related to managing the fund, making it an attractive option for both new and experienced investors alike. Additionally, there is no minimum investment requirement, which further lowers the barrier to entry for individuals looking to invest in large-cap stocks. In terms of performance, the fund closely mirrors the returns of the S&P 500 index. As of July 23, 2024, the fund has achieved gains of approximately 18% year-to-date, which closely aligns with the performance of the S&P 500 over the same period. This consistency in performance reassures investors that the Fidelity Zero Large Cap Index Fund effectively tracks its benchmark index and delivers competitive returns. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Number 3. Fidelity US Sustainability Index Fund. The Fidelity US Sustainability Index Fund benchmarked against the MSCI USA ESG Leaders Index, which focuses on tracking the performance of large and mid-cap domestic stocks that exhibit above-average environmental, social, and governance ratings. This index fund is designed for investors interested in aligning their investments with sustainability principles without compromising on financial performance. One of its key advantages is a low expense ratio of just 0.11%, making it cost-effective for investors. Additionally, there's no minimum investment amount required, which enhances accessibility for a wide range of investors. As of April 30, 2024, the Fidelity US Sustainability Index Fund shows significant sector concentrations in technology, 28.5%, healthcare, 11%, and financial services, 11%. These sectors are pivotal in driving innovation, healthcare advancements, and economic stability, reflecting the fund's strategic allocation towards industries with strong ESG credentials. The top holdings of the Sustainability ETF include prominent companies known for their robust ESG practices, such as Microsoft, Nvidia, Google's parent company Alphabet, Tesla, and Eli Lilly. These companies are recognized not only for their financial strength, but also for their proactive approach to managing environmental impacts, fostering inclusive workplaces, and maintaining high standards of governance. Investing in ESG-focused funds like the Fidelity US Sustainability Index Fund appeals to socially conscious investors who prioritize sustainability alongside financial returns. Research indicates that companies with strong ESG profiles often outperform their peers financially over the long term. By integrating ESG factors into investment decisions, the fund aims to capitalize on these superior financial performances while promoting sustainable business practices across its portfolio. Number 4. Vanguard Real Estate Index Fund ETF. The Vanguard Real Estate Index Fund ETF, with the ticker VNQ, stands out as a strong and cost-effective option for investors looking to gain exposure to the real estate sector. With an impressively low expense ratio of just 0.12%, VNQ is not only highly affordable, but also the largest real estate index fund available, boasting total net assets exceeding $59 billion. This substantial size reflects its popularity and credibility among investors seeking exposure to real estate through a diversified portfolio. VNQ tracks the MSCI US Investable Market Real Estate 25/50 Index as its benchmark. This index broadly represents equity real estate investment trusts in the United States. While it includes a few real estate management and development firms, the majority of its holdings consist of equity REITs. These REITs specialize in owning and managing income-generating real estate properties across various sectors such as residential, commercial, retail, and healthcare. One of the key attractions of VNQ is its appeal to dividend-focused investors. As of April 30, 2024, the ETF offered a 12-month dividend yield of 4.01%. This makes VNQ particularly attractive in an environment where investors seek reliable income streams from their investments. Dividends from REITs are often favored for their potential to provide regular income, supported by stable rental income from properties within the portfolio. Additionally, VNQ holds appeal for investors concerned about inflation. Real estate investments, including those through REITs, are traditionally considered a hedge against inflation. This is because property values and rental income tend to rise alongside inflationary pressures, providing a measure of protection against the eroding purchasing power of currency. As such, VNQ can serve as a strategic component in a diversified investment portfolio aimed at mitigating the effects of inflation on overall investment returns. Number 5. Vanguard Growth Index Fund ETF. The Vanguard Growth Index Fund ETF, with ticker VUG, stands out as a strong investment choice for those seeking exposure to US large-cap growth stocks. This ETF tracks the CRSP US Large Cap Growth Index, known for closely mirroring the performance of the S&P 500 Growth Index. By investing in 200 of the largest and fastest-growing companies in the United States, VUG offers investors a diversified portfolio within the growth sector. The fund's portfolio is predominantly weighted towards technology stocks, industrial stocks, and the consumer discretionary sector. These sectors are known for their dynamic growth potential and innovation-driven opportunities. In contrast, consumer staples and utility stocks constitute a very small portion of the fund, each making up less than 1% of its total value. This sector concentration reflects VUG's focus on capturing the higher growth potential of companies leading technological advancements and consumer trends. One of the standout features of the Vanguard Growth Index Fund ETF is its exceptionally low expense ratio of just 0.04%. This means that for every $1,000 invested, only 40 US cents goes towards covering the fund's operating expenses annually. Such a low expense ratio is advantageous for investors as it minimizes the drag on returns over the long term. Performance-wise, as of July 23, 2024, VUG has demonstrated strong returns with a 23.33% growth year-to-date. Over the past 5 years, VUG has increased by approximately 121.35%. This performance highlights the ETF's ability to capitalize on the growth potential of its underlying stocks, particularly in the tech sector, which has seen significant surges in recent months. Throughout 2024, fueled by the robust performance of tech stocks, VUG has outperformed the broader S&P 500. This shows its role as a high-performing option within the growth-oriented segment of the market. Number 6. Schwab Emerging Markets Equity ETF. Investing in emerging markets can offer growth opportunities, especially for investors looking to diversify their portfolios beyond the established economies like the United States. The Schwab Emerging Markets Equity ETF presents an attractive option for those seeking exposure to high-growth markets while spreading risk across multiple countries. SCHE tracks the FTSE Emerging Index, which includes a diverse range of large and mid-cap stocks from over 20 developing countries. This index composition helps mitigate the risk of economic downturns or political instability in any single country or region. With 1,995 holdings, the ETF offers broad exposure across various sectors and markets within emerging economies. Key countries where SCHE has significant holdings include China, India, Taiwan, Brazil, and Saudi Arabia. These countries represent major emerging market economies known for their growth potential and diverse industrial bases. By investing in SCHE, investors gain exposure to companies driving economic expansion in these regions, ranging from technology and manufacturing to consumer goods and financial services. One of the appealing aspects of SCHE is its low expense ratio of just 0.11%. This means that for every $1,000 invested, only $1.10 goes towards covering the fund's operational expenses annually. Such low costs are crucial for long-term investors as they help maximize returns by minimizing overhead costs. It's important to note that historically, stocks in emerging markets have shown high volatility and sometimes underperformed compared to US stocks. This discrepancy underscores the higher risk associated with investing in emerging markets. However, despite short-term fluctuations, emerging markets offer compelling opportunities for growth over the long term. Approximately 85% of the world's population resides in developing countries, representing vast consumer markets and untapped economic potential. Investors with a long-term horizon and tolerance for volatility may find SCHE as a suitable addition to their portfolio, aiming to capitalize on the growth trajectories of emerging economies. Number 7. The Vanguard Russell 2000 Index Fund ETF. The Vanguard Russell 2000 Index Fund ETF with ticker VTWO provides investors with an opportunity to capitalize on the potential growth of small-cap companies. This ETF tracks the performance of the Russell 2000 Index, which comprises 1,960 small and mid-cap companies. As of December 31, 2023, the median market capitalization of companies in this index was approximately $2.9 billion. Investing in the Vanguard Russell 2000 Index Fund ETF allows investors to gain exposure to a diverse range of sectors. The fund's largest sector allocations as at the end of 2023 were in industrials, 19.3%, financials, 15%, and healthcare, 14.8%. These sectors represent key areas where small-cap companies are active and poised for growth. One of the attractive features of the Vanguard Russell 2000 Index Fund ETF is its low expense ratio of 0.1%. This fee is relatively low compared to other funds that offer exposure to small-cap stocks, making it cost-effective for investors seeking growth opportunities in this segment of the market. Despite its growth potential, VTWO, like its benchmark index, has faced challenges in recent months. During the first 4 months of 2024, both the index fund ETF and the Russell 2000 index experienced declines of more than 2%. This decline reflects broader market trends affecting small-cap stocks, which have struggled amid economic uncertainties and market volatility. Furthermore, as of July 23, 2024, VTWO has a year-to-date growth of approximately 11.63%. Investing in index funds can be a cornerstone of a robust long-term strategy and portfolio. By choosing wisely and holding for the long term, you're positioning yourself for sustained growth and stability. The best index funds align with your financial goals and risk tolerance. Which index fund are you considering? Share your thoughts below in the comments section, and don't forget to like and subscribe for more valuable content. Also, feel free to watch the next video on the screen for more valuable insights. Thank you for watching.